September 15th, 2008. Lehman Brothers, a 158-year-old giant, collapsed overnight. $600 billion vanished. Millions lost their homes. The world economy nearly died. But here's what they didn't tell you. This wasn't an accident. It was a crime scene hidden in plain sight. Cut to host. Welcome to Finance Forge, where we hammer out the truth. I'm your name. And today we're exposing exactly how the 2008 financial crisis happened. Not the sanitized version, but the real story. Stick around till the end because we'll reveal who actually profited from this disaster. Subscribe animation. If you want to learn finance the way they don't teach it in school, hit that subscribe button right now. Early 2000s. Let's rewind to 2001. After the dot-com bubble burst, the Federal Reserve dropped interest rates to historic lows, down to 1%. Money became dirt cheap. Banks were desperate to lend it out and make profits. Animation. Money flowing from banks to homes. Here's where the game begins. Traditionally, if you wanted a home loan, you needed good credit, a down payment, and proof of income. But banks discovered something revolutionary and dangerous. Show document. Mortgage-backed security. They realized they could bundle thousands of mortgages together, slice them up and sell them to investors as mortgage-backed securities or MBS. Think of it like this. Imagine. You have a pizza made of 1,000 different mortgage payments. You slice it up and sell each slice to different investors. They get monthly payments. You get cash up front. Everyone wins, right? Dramatic pause. Wrong, because this created a deadly incentive. Here's the untold part. Once banks could sell mortgages immediately, they stopped caring who they lent to. Why? Because it wasn't their problem anymore. Animation, mortgage assembly line, enter the ninja loans, no income, no job, no assets. Literally anyone could get a mortgage. Strippers in Florida were buying 5 investment properties. People making $30,000 a year were approved for $500,000 homes. Show real examples, blurred documents. Mortgage brokers were paid on commission. The more loans they made, the more money they earned. They had zero incentive to check if borrowers could actually pay. Ratings agency logos appear. But wait, didn't someone check if these mortgage bundles were safe? Yes, rating agencies like Moody's and S&P. They were supposed to be the watchdogs. Graphic. Conflict of interest diagram. But here's the scam. Banks paid the rating agencies to rate their products. It's like paying the restaurant inspector to give you 5 stars. 95% of these toxic mortgages got a AA ratings, the safest possible rating. The same rating as U.S. Treasury bonds. Shocking stat overlay. By 2006, over 40% of all new mortgages were subprime, meaning risky borrowers who'd likely default. And these were being sold worldwide as safe investments. 2006. Housing prices stopped rising. Why does this matter? Chart. Housing prices plateau then crash. Because the entire system depended on one assumption. Home prices always go up. People with adjustable rate mortgage suddenly saw their payments double or triple. They couldn't refinance because their homes were now worth less than their mortgage. Animation. Dominoes falling. Defaults began. First a trickle, then a flood. Remember those mortgage-backed securities? They started failing. Banks that owned them started losing billions. Timeline of bank failures. March 2008. Bear Stearns. Collapsed. Bought for pennies by J.P. Morgan. July 2008. IndyMac Bank failed. $32 billion gone. September 2008. Lehman Brothers. The big one. $600 billion bankruptcy. Stock market crash animation. The Dow Jones lost 778 points in a single day, the biggest point drop in history at that time. Credit froze. Banks stopped lending to anyone, even each other. The entire global financial system was hours away from total collapse. Show real footage of ATM lines. News headlines. 8.7 million Americans lost their jobs. 6 million lost their homes. $16 trillion in wealth vanished. Retirement accounts cut in half overnight. Here's what most people don't know. While millions suffered, Some people made fortunes. Graphics. The Big Short references, no movie clips. Just facts. A few investors saw this coming. They bet against the housing market using credit default swaps, essentially insurance policies on mortgage bonds failing. Show names, firms, text only. Michael Burry's fund made $700 million. John Paulson's hedge fund made $15 billion. Goldman Sachs made money both ways, selling toxic mortgages. A&D betting against them. Key revelation: Goldman Sachs actually helped create mortgage products specifically designed to fail, then bet against their own clients. They paid a $550 million fine, just 4% of their profits that year. Justice scale graphic. The aftermath? The government bailed out the banks with $700 billion in taxpayer money. Only one major banker went to jail, one, out of thousands who orchestrated this. So, what's the lesson from 2008? Few takeaways appear on screen. First, when incentives are misaligned, fraud becomes inevitable. Brokers, banks, rating agencies, everyone profited from the lie. Second, complexity hides risk. Those mortgage-backed securities were so complicated that even the people selling them didn't understand them. Third, the system protects itself. Banks were too big to fail, so taxpayers paid the bill while executives kept their bonuses. Forward-looking statement. Here's the scary part. Many of the same conditions exist today. Different assets, same playbook. That's why understanding financial history isn't optional. It's survival. Final call to action. If this opened your eyes, subscribe to Finance Forge. We're forging financial literacy, one truth at a time. Drop a comment. Did you or your family lose anything in 2008? Let's talk about it. End screen with subscribe button and next video recommendation. Next week, could 2008 happen again? The warning signs nobody's talking about. See you then.